When we analyze charts, we usually define a trading range using swing highs and swing lows. But what if a single candle could define the entire range? This is the core of candle range theory. Now, if we look at this daily candle on the 1-hour time frame, we can see that the upper wick acts as a swing high and the lower wick acts as a swing low on the hourly chart, which creates a local trading range. However, while this may seem like basic market knowledge, if we combine it with smart money concepts, this single setup can become a consistent, high-probability trading opportunity. Welcome to Graph Insight. In this video, we'll cover everything you need to know about candle range theory in 5 simple steps. If you find this topic useful, make sure to like the video and subscribe to the channel. In the first step, we'll understand how to use the CRT strategy to identify trading setups. For this, we only need 3 candles. Let's start with the first one. The first candle is bullish on the daily time frame. Using the upper and lower wicks of this candle, we define liquidity levels. The upper wick marks our candle range high, and the lower wick marks our candle range low. These levels are critical because they represent buy-side and sell-side liquidity. Now here's the key moment. After this candle forms, we expect the next candle to break above our candle range high, but then return and close back inside the candle range. After that, we anticipate that the third candle will target and break the candle range low, and that becomes our opportunity to enter a short position. This makes sense because the candle range high and candle range low represent liquidity levels, and as we know from smart money concepts, price moves toward liquidity. That's why, after the second candle creates a liquidity sweep above the candle range high, we expect the next target to be the liquidity resting below the candle range low, and we enter a short position. Now that we've broken down candle range theory, you might be wondering which candle on the chart can we actually use to define our candle range. Technically, it can be any candle and on any time frame. However, there are specific criteria that significantly increase the probability of this setup, and we'll talk about them later in the video. Next, if the second candle breaks the candle range high and does not close back inside the trading range, then the setup becomes invalid, because in that case, price is highly likely to continue moving upward. Now, if all the criteria are respected for the first 2 candles, we can enter a short position on the third candle. Although we've explained candle range theory, we haven't yet covered how to properly execute the trade in this scenario. So let's move to a lower time frame for a more precise analysis. Here we can see the candles formed during the first daily candle. They create our buy-side and sell-side liquidity. Then, as we move into the next day, we see a liquidity sweep above the buy-side liquidity, after which price moves back into the trading range. At this stage, we can identify a change of character and a fair value gap formed during the move. This confirms that the next target for price is the sell-side liquidity. The fair value gap formed during the previous price move becomes our entry point for the short position, since price often returns to this area to fill the imbalance created during the move. Once price reaches the sell-side liquidity, the setup is considered complete. At this point, we've broken down the bearish scenario of this setup. However, there is also an equivalent bullish scenario. Let's quickly go through it for better understanding. First, we see a bearish daily candle that forms the candle range high and the candle range low. After that, a bullish candle follows, which creates a liquidity sweep below the candle range low and closes back inside our range. The criteria for the first 2 candles are respected, so we move to the 1-hour chart for a more precise entry. On the chart, we clearly see the liquidity sweep, followed by a change of character and a fair value gap. Now we wait for price to return to the fair value gap and enter a long position. Once price reaches the candle range high, the setup is considered complete. Step number 2 is using premium and discount zones while trading CRT. But before we continue, I want to quickly mention that I share daily market analysis and trade setups inside my Telegram community. So if you want to see how a professional trader analyzes the market every day, make sure to join my free Telegram community. The link is in the description. If we take our candle range and divide it into 2 parts, the upper half is considered the premium zone and the lower half the discount zone. Our goal is to enter long positions only when price is in the discount zone and short positions only when price is in the premium zone. We use this rule to achieve a better risk-to-reward ratio when entering a trade. For example, on this 1-hour chart, we can see that price has already formed a liquidity sweep above the candle range high, and we expect the next target to be the candle range low. Looking at the internal structure, we see a change of character and a bearish fair value gap. However, if we divide the candle range into premium and discount zones, we can notice that the fair value gap is formed within the discount zone. Therefore, entering a short position in this case would not be optimal. However, in the next similar scenario, we can see that the fair value gap is formed in the premium zone. In this case, we enter a short position because it provides us with a better risk-to-reward ratio. Step number 3, CRT setups can include more than 3 candles. For a valid CRT setup, having exactly 3 candles is not mandatory. The key requirement is that the market structure follows the AMD model: accumulation, manipulation, and distribution. If we visualize this structure on a line chart, it would look like this. First, we see the accumulation phase in the form of consolidation. Then comes the manipulation phase, which represents a liquidity sweep. After that, we have the distribution phase, the phase where we enter the trade. Now, if we look at this sequence of 5 candles, we can identify the first candle that defines our candle range. After that, we see 2 candles representing accumulation. Then comes the liquidity sweep, which is the manipulation phase. And after these 2 phases, we enter a short position during the distribution phase. This shows that the time required for a CRT setup to form is relative. It can develop over several candles, or even just 2 candles, which we'll discuss in the next step. Step number 4, proper time frame alignment. As I mentioned before, in this example, we can see a setup formed by 2 daily candles. The second candle first takes liquidity above the candle range high, then moves down toward the candle range low, takes liquidity there as well, and closes in that area. In this scenario, the second candle performs both the manipulation and distribution phases at the same time. However, if we move to the 1-hour chart and analyze its formation, we can see that the AMD structure is preserved in its usual form. First, we see accumulation, then manipulation in the form of a liquidity sweep, and finally, distribution. This shows that looking at this setup only on the daily time frame does not allow us to properly track the market structure for a precise entry. That's why we use the daily time frame only to define our candle range, and only after that move to the 1-hour chart for a more detailed analysis. This is called time frame alignment, and here are the best time frame pairs for it. For example, if you are analyzing a 4-hour candle, you move to the 15-minute chart to track the market structure. Or if you are analyzing a 15-minute candle, you can move to the 1-minute chart for a more precise structural analysis. Step number 5, which candle to choose when applying CRT. One of the most popular approaches among traders is trading the first hourly candle before the New York session opens. This approach makes sense because the New York session is often characterized by strong reversal moves, especially right after the open. Here's how it works. We draw the trading range of the first 1-hour candle before the session opens. Then we wait for a liquidity sweep to form on the second candle. Once that happens, we move to the 5-minute chart to analyze the market structure. Here, we identify a change of character and a fair value gap. We also see that the fair value gap is formed within the premium zone of our trading range, which makes it an optimal entry point. We wait for price to return to that zone and enter a short position. Once price reaches the candle range low, the setup is considered complete. As I mentioned earlier, this approach makes sense. However, it has one drawback. We are trading against the trend. For that reason, this setup carries higher risk. Now let's move to another example. On the daily chart, we can clearly see a market structure with higher highs and higher lows, which indicates an uptrend. After price forms the latest break of structure, we look specifically for a bearish candle to apply the CRT model, aiming to trade with the trend rather than against it. We mark the high and low of each candle and wait for the reaction of the next one. If the next candle breaks below and closes outside our range, we mark that candle as well and continue waiting for the next reaction. We repeat this process until we see a liquidity sweep below the candle range low. Once that happens, we move to the 1-hour chart to analyze the market structure and enter a long position. This approach is safer for consistent use because it follows the trend, unlike the New York session setup. Let's move to the next example. On this chart, we see a bullish candle and a liquidity sweep relative to its candle range. At first glance, the setup looks promising. However, if we zoom out, we notice that for price to reach the candle range low, it would first need to break through this bullish fair value gap, which also overlaps with a bullish order block. This tells us that the current market environment is bullish, which works against our short setup. And if we look at how price reacts afterward, we can see that price moves upward and does not confirm our setup. However, the latest candle now looks more interesting to us as it is formed at the level of the previous major high. This means that from this level, price is highly likely to create a liquidity sweep, which gives us a strong trading opportunity. Thank you for watching. If this breakdown helped you see the market more clearly, make sure to like the video and subscribe to Graph Insight. Let me know in the comments which concept you want me to break down next. I'll see you in the next video.